Welcome to the Explainer. Today, we are breaking down the Q3 2025 earnings call for GoodRx. That's ticker GDRX. Okay, so let's get right into it. The headline numbers from GoodRx this quarter, well, they were kind of all over the place. You had revenue that beat what Wall Street was looking for, but then earnings per share actually missed. It kind of leaves you scratching your head, right? So what is the real story here? All right, first up, let's break down the actual numbers. And like I said, it's a bit of a mixed picture when you first look at it. So as you can see, revenue came in at $196 million, just squeaking past what analysts were expecting. But, and this is a big but, adjusted earnings per share missed by a penny, landing at 8 cents. Now, what I think is really interesting here is the adjusted EBITDA margin, 33.8%. That's up half a percentage point from last year. And what that tells you is that management is being really disciplined with costs, protecting the bottom line. Okay, but here's the crucial thing. And if you take one thing away from this, it should be this. Those headline numbers, they don't even begin to tell the real story. To really get what's going on with GoodRx, you have to look under the hood. It's almost like you're looking at two totally different companies living under one roof. And believe me, they are heading in completely opposite directions. And this brings us right to the core of the story this quarter. It's really a tale of two segments, and you can see the company's big strategic shift happening right before our eyes. Just look at this. It's pretty dramatic, right? On one hand, you have their manufacturer solutions business. That's the part that works directly with drug companies. It's absolutely exploding, up 54% from last year. Then you have the other side, the one you probably know best, the prescription transactions, the discount card. That part actually shrank by 9%. A huge, huge difference. And this chart really puts that shift into perspective. The legacy prescription business is still the biggest piece of the pie for now, at about $127 million, but look at manufacturer solutions at over $43 million. It's not just a side project anymore. It is, without a doubt, the engine that's going to drive this company forward. So how is management talking about all this? Well, they're not framing this as some kind of desperate retreat from a dying business, not at all. They see it as a full-on, proactive charge towards a huge opportunity, what they call owning the pharmacy counter. And here's the CEO, Scott Wagner, laying it out. He says they're focused on pharmacy counter integrations. What does that mean? Basically, the game plan is to change GoodRx from just being an app on your phone to being software that's absolutely essential for the pharmacy itself. They want to be the direct link between the drug makers and you, right there at the point of sale. So how are they actually doing this? Well, it's a multi-pronged attack. First, they're digging in deeper with big retailers, like their program at thousands of Kroger pharmacies. Second, they're beefing up direct-to-consumer programs for those blockbuster drugs you hear about, like the GLP-1s for weight loss. Third, they're getting involved in policy, aligning with things like the Trump Rx platform that's all about price transparency. And finally, they're rolling out new subscription services. They're attacking this from every angle. Okay, so what about the future? Let's talk about the guidance management gave and some of the big topics from the Q&A. And really, it's a classic story of trying to balance some pretty strong headwinds and tailwinds. So on the one hand, you've got some real challenges. The Rite Aid store closures are a drag. They've also got lower volume from one of their big partners. They're even telling us to expect revenue to dip a little bit next quarter. But on the other hand, the good news is really good. That manufacturer solutions business is on fire, and the whole political landscape seems to be shifting in their favor, pushing for the exact kind of model that GoodRx is built for. And, despite all those headwinds, management stood by their full-year guidance, and that's a big signal of confidence. They're still calling for revenue to hit at least $792 million for the year. And here's the kicker. They're projecting that manufacturer solutions segment will grow by about 35% for the whole year. That's where the growth is coming from, plain and simple. Okay, let's put it all together. This is where we synthesize everything we've heard and make our call on the stock. What does this all mean for investors? So what's the bottom line here? It all boils down to one simple question. Can this amazing growth from their new business make up for the decline in their old business? And maybe more importantly, can it happen fast enough to get the whole company growing again? So here's our take. The move they're making, this pivot, it is 100% the right move. But Wall Street is a skeptical place, and we think investors are going to stay on the sidelines until they see that old legacy business stop bleeding. Until that happens, there's probably a ceiling on how high the stock can go. It's what we call a show me story. They have to prove it. And because of that, we're giving GoodRx a rating of market perform. Look, the growth for manufacturer solutions is fantastic, it's exciting, and it shows the long-term plan is working. But you just can't ignore the uncertainty hanging over the bigger, older part of the company. The good is balanced out by the questionable, at least for now. And as always, remember, this analysis is for informational purposes only. This is not financial advice.